oil and gas originally, which thankfully we're not nearly as deep in now. Got into the gym business in 2004 and have been in the hotel business probably for 25 years now. We're no longer in the gym business. We're lightly in the oil and gas space still. And then primarily Omni Hotels is our largest asset. We invest pretty significantly in private equity, one-off deals with our own capital. But lion's share of where we're putting capital to work is still in the hotel business. That's just a little background on TRT.
Thank you, appreciate it. Dupree? Dupree with us? Anybody want to check on Dupree? Kevin, you want to go?
Sure. Good afternoon, everybody. I'm honored to be here. Kevin Dietz with Ambridge Hospitality. So Ambridge is a third-party hotel management company. So we are privately owned by a PE sponsor called Advent out of Boston. We've probably recapitalized 3 or 4 times since we started in 2003. And so we have very little real estate on our balance sheet to speak of compared to Dupree and Blake. But primarily, if you think about the hospitality space and the three-legged stool, you've got the owner of the real estate, you've got the franchisor, which is the brand, and then you've got an operator. And the third leg is generally where Ambridge operates.
Can you hear me now, Paul?
Oh, yeah.
There we go. Good afternoon. My name is Dupree Scoville. I'm with Woodbine Development Corporation. It was a company started by my father about 47 years ago. My brother and I now operate the company. It started as a partnership with the Hunt family and has since evolved into a series of funds that we do primarily with family offices and foundations. We are generally focused on hospitality, although we have a secondary focus on office and multifamily to a much lesser extent. But unfortunately, at least for now, the majority of our exposure is in hotels. And good or bad, we're going to get through it one foot in front of the other right now.
Thanks, Dupree. Yeah, so broad categories of topics we'll cover today. I'm very open to letting the panel sort of steer the questions however they want, but we'll try to cover the current conditions and future trends, capital markets response, forecast and recovery, and diversification of revenue, a new focus on cleanliness, and of course the impact of things like Airbnb. Well, I guess I'll kick it off with sort of a general question to all you guys. So what's the current state here? Where are we at? And what's your best forecast for the future for hotels and hospitality in general?
I'm happy to start on that. I would say current state, as I'm sure most people on this call know, is there aren't really superlatives strong enough to describe how bad it is. We're still 65% down in RevPAR. Last month was our roll up of all of our hotels. We're largely where we cater to kind of where group and to group and leisure primarily, and the leisure side and drive to our drive-in destinations are still performing decently well. Our group houses are anemic, as you would imagine. Luckily, we have a portfolio of resorts that are performing by no means where they were in 2019, but performing decent in comparison to the group houses. But it's a long way of saying we've got a long road to recovery, and it's still in a very, very bad place. We're on a week-to-week basis, it's getting better, but it's off an incredibly low base. So it's creeping back. And for our business, until groups start traveling again and meeting again, it's going to be pretty rough. And I don't know what changes that, whether it be, herd immunity or vaccine or getting past the election or a combination of all of them. But our business will be pretty tough until groups start traveling again. And like I said, it's a little bit hotel to hotel. Some do more leisure transient travel than others. The resorts clearly do a whole lot of that, and they're what's keeping the boat afloat at this point. But we need groups to start traveling again and people to start getting together in groups.
Is it geographic in nature at all? Do you see any trends there?
It's geographic in the sense that different states have different regulations related to the virus, but people want to travel. I mean, it's individuals and families. So, we've got resorts across the entire country, and they're all performing on a relative basis well.
Right. Dupree?
Oh gosh, yeah, not too great. There's a few statistics that I think are helpful. I mean, this may sound obvious, but two-thirds, I think, of the aircraft in the U.S. are grounded. I think it's something like 18 airlines have filed for bankruptcy. That's not good for the travel business. And a common refrain you've probably heard is just the magnitude of this, of the impact on the hotel industry versus 2000 and 2009. I think those two combined, call it around 20 billion in loss between those two previous corrections. We're talking about 95 billion in 2020, so literally 5x what we've seen on those past two combined. So it's to say that it's a bad day is probably an understatement. Just to give you a little picture, like that's macro stats, but from a micro standpoint, if you're looking at Woodbine, we were single-digit occupancy in March, which has just never happened before across our portfolio. That started to climb. Then July 4th, we kind of saw a resurgence in cases, a big spike again, which kind of set occupancy back. That's now steadily climbing, much like what Blake mentioned. Although we're probably around 42 or 43% this week, first time we've been in the fours since pre-COVID, which just to give, since this is primarily a finance group, to give you a sense in hotels, depending on leverage, which will be different for Blake than others, but you don't really make money unless you're in that kind of 60% occupancy range. So we've got a long way to go. And I think that's where you're going to see a lot of distress over the course of the coming months. I'll skip that and Kevin, jump to you.
Yeah, appreciate that. So I probably have the most weighted or balanced look at the industry and where it is, only because we manage across 14 different hotels across the spectrum of limited service, economy, extended stay hotels, all the way up through big box hotels like Dupree and Blake, resorts and independents. So it's a good cross section. And generally speaking, and I don't think anybody disputes this, April was the most devastating month in the industry's history. So we are actually down for our portfolio 85% to RevPAR, which is revenue per available room, relative to 2019. So we have slowly and steadily climbed out of that. We ended up made a decision with our ownership groups to shut down 20% of our hotels. Today, actually Labor Day, we hit, I think that was our peak. We were down about 50% in RevPAR, and the last, call it 2 months, we've kind of plateaued at about 58% down from last year. And so what that means holistically is our occupancies are almost to 50%, just again, weighted average basis. But a lot of that is being pulled up because of, 2/3 of our hotels are limited service. They're the drive-to markets that Blake had mentioned. And so we're getting some good lift out of those. And then there was kind of a question about geographic markets. And so we're really seeing there's a geographic flight from urban to suburban markets. And so we unfortunately do have some hotels in some of the larger MSAs, Manhattan, San Francisco, Chicago. And so, anecdotally, we've got the Roosevelt, and there was some news on that. It's owned by the Pakistani government. And so they made the decision last few weeks to shut that down, and it's going to be repurposed and move out of hospitality into the commercial side. So some real interesting things going on, especially in these urban markets where, there's going to be a recovery, but it might not be to the levels that we saw, might not ever get back there. So that's kind of what we're seeing on our side, just again, as a lens, from the lens of a property manager.
Right. So why wouldn't we get back to where we were, and how, if anyone really could add some more color on this micro view of of recovery, you know, what asset classes within hospitality are going to recover? Why wouldn't some of the other asset classes recover? Anyone?
I think Blake hit it. I'll jump in, but Blake hit it in his intro, is that until there's a vaccination or therapeutics or whatever it is, and people feel comfortable, they're not, as a company or organization, going to send their folks traveling. And I think there's been, you know, some moderate success with Zoom. And so there's going to be some companies that ultimately say that we can accomplish our business needs without having to get an airplane. And for the ones that were looking to save a little bit of money too, it's just an appealing option. Now, I don't think that's going to represent the majority, but I do think there's enough of that out there to say that it might not ever get back to where we were.
Yeah, you know, I might add to that, and Blake, you can probably riff off this, but if you just got to think about functionally how booking a group works, right? If anybody on this call wanted to have a corporate retreat, you don't plan it a month or 2 or 3 in advance, right? You're having to book a hotel a year in advance, and then you'll have non-refundable deposits that could be as much as 30, 40, 50 grand, even for a small event. And that can be, you know, even 6 months out when you got that kind of non-refundable commitment up. So the nature of that doesn't suggest a V-shaped correction. You know, the minute we have some sort of vaccine or post-election, what likely happens is that group business, which is kind of critical for some of our hotels for sure, and the industry at large, that's going to take a while to come back, because most of these folks are saying, well, if I can't plan it now, we're just going to have to bump to 22. They're not necessarily looking at 21 with much optimism. I do think there's going to be somewhat of a rebound, but the velocity of group, I think that's why you see most of the predictions suggesting this will be 2024 until you really see a pre-COVID comeback. So, you know, you asked one question about kind of what segments rebound and which ones don't. I think like urban, obviously, just because of the density, that's going to have a slower rebound. Anything that's relying on a lot of group is going to have a slower rebound. So that I think select service, that's probably somewhere in between those, is going to be able to control margin and probably do much better. But as Blake mentioned, I think earlier, it's not necessarily great business, and you're having to take a much lower rate just because there's so much supply available. So it may be a while.
And Paul, you asked which markets aren't going to come back. You know, and earlier I said it wasn't really geographically focused, but to Kevin's point, I mean, we're seeing good business at the resorts across the country, but it's definitely geographically located, like you said, in the urban markets. I mean, we closed the Berkshire in New York permanently, and the reality is the market and the cost structure of operating up there was already tough, and the competitive nature and the amount of supply that entered the market, even in 2010, 11, 12, 13, when no hotels were really being built around the country, they were still being added to the New York market. And so it was a tough market in 2018 and 19. And then you layer this on, I mean, it's going to be tough for New York to come back, and because people weren't making hardly any money anyway, even prior to the virus.
And I just read today, I guess, some California regulations coming out on the theme parks and putting a lot of stress on that. You know, all the surrounding businesses sort of the same way. In highly regulated environments, it's even going to be doubly tough. But so where does it go from here? I mean, ultimately, you've got huge investments in assets that can serve some purpose, I suppose. Are there ways to diversify revenue to bridge the gap? Blake or Dupree on that?
Sure, I can jump in on that. I think what you're going to see is, just the kind of old-fashioned highest and best use equation, right? So you're going to see hotels that can convert to multifamily. You're going to see hotels used as day offices. You're going to see hotels that have larger rooms have kind of a multi-use component where you've probably got corporate apartments and extended stay within, a hotel that probably didn't used to be like that. So I think there's going to be a lot of creative ways that people start to try and generate revenue. I mean, even operating a hotel where, you're taking cues from what the market is currently offering, like Uber Eats or DoorDash and everything else like that, and you're trying to provide that experience within the hotel. So it's getting away from what we traditionally did on room service, and now that may be on an app, and the bartender might actually bring the mixed drink to you in your room. I mean, instead of waiting, 20 minutes and you get a silver can on top of a, cold food with a wilted flower next to it, right? There's probably just a lot of changes like that I think end up happening.
So some innovation dollars, maybe that's already in the pipeline, but it sounds like that probably costs money.
No, that's right. And plus, a lot of that stuff's going to be contactless, which is nothing new for the industry. It's been trending that way for a long time. But you're going to pick your room on your phone. You're going to check in on your phone. You're going to access your room on your phone. You're going to control the TV on your phone, control the lights, control the AC on your phone. Again, those take investment. But you're also realizing savings on the labor side. Not easy to implement. A lot of that takes bandwidth and some infrastructure to be able to do. But for the hotels where we've got that, those are things that we're doing.
Okay.
Yeah, I mean, call me naive, but I believe things are going to get back to normal, or at least mostly what was normal before. This has drug on far longer than I would have predicted, and I have no crystal ball of when we're going to come out of it. But people want human interaction. People want to travel. This is a virus that's not. We've reacted differently than any other time in the world, but it's not different than other viruses we've had. It's not as deadly as many we've had. We will get past it, and it'll take time, largely because what Dupree said earlier. I mean, nobody's booked a single. People are usually booking years out, and nobody's booked anything for the last 8 months. It's been all cancellations, so it'll take time to bounce back. But we've battened down the hatches to ride this thing out for the long haul. We still have, call it 8 hotels that are closed, mostly in the higher cost of operating structure markets like New York, some West Coast, mostly Northeast, and and we're operating a lose less model at the rest of them, and then the resorts are actually making money. So, we've skinnied down the operation to ride out the storm. But I think on the other side of the storm, people are good. There's a lot of pent up demand, and it's not going to be a V shape like Dupree said, because it just takes time for groups to recongregate and to book their meetings and have their events. But I think once we're on the other side of this, there's not going to be any growth in supply for a long time. These projects take, at least in our space, in the upper upscale or luxury space, it takes a year to work on a project. Once you have a project teed up, it takes a year to draw it and plan it, and takes 2 years to build it. So we're going to have a good window of no supply increase for quite some time. And in certain markets like New York, I think a ton of rooms are going to come out of the market when we turn the corner and come out of this phase we're in right now.
Mm-hmm.
It's a really good point, Blake, is I do think there's going to be some good things. And I also believe in the industry long term, but I think brand standards, some of the things that we're doing to batten down the hatches are going to be kind of the new norm, right? So think about, you get your room cleaned every night, and that's just par for the course. And so now, because of COVID and contactless, we're going in there only between stays, and so we're the guest experience is changed, and that's something that might change permanently, where you only get your room cleaned between stays and not every night. And so that will obviously ripple through on the cost side. And so just a new way of doing business just by surviving this.
Well, I'm glad there's some hope out there for sure. I'm hopeful too. And I think there is a lot of pent up demand. I do agree with that. So I'm curious how your financial partners are dealing with it, and what's the response there? What kind of scenarios, whether banking partner, debt partners, or equity partners, that I'm sure there's a variety of scenarios out there, from having to take certain people out, recapping, bringing in different partners. I know you guys are probably all capitalized a little bit differently. You know, Aimbridge will probably have more corporate debt. Blake, being primarily in a family office, maybe more on the equity side. But then Dupree. So how are your financing partners reacting, and what kinds of measures are you having to take to move things forward?
Kevin, I'll follow your lead.
Yeah. All right. Well, I'll jump in on that. So, you know, again, Advent owns Aimbridge, 80 something percent owned, private equity. And so their investment in us is only 18 months old. So they, after they acquired us, we went ahead and acquired Interstate, which is the second largest company in our space. And so one joined up with two. And so we're 7x larger than the next guy. So what their focus was is that, you know, there's an IPO story and a path there to be told. And so we were out in the market seeking some debt, and just to kind of boost operational liquidity. And we'll get to that in a little bit, but there is money to be had out there for the right story. And so the idea for us was create enough runway so that, you know, when the recovery hits, we'd be positioned. But the interesting thing there is that the investment thesis was built that we would be, you know, that much better than the next guy in terms of scale, quality, talent. And so we're putting that investment thesis to work a little bit faster than kind of everybody wanted, not under our own terms. But I think it's the ultimate litmus test for a road show where we take this company and try to do what nobody's done before, which is go public with it. So that's kind of how our partners are looking at it. Of course, we had to do a lot of things to batten down the hatches on our side. So we did salary freezes, actually reduced salaries by 20% across the board. We ripped out our bonuses. We have probably had 65,000 employees on staff. And again, most of those are at the hotel, and we're down to maybe 30,000 today. So lots of layoffs and furloughs. And so we're hoping that as, you know, revenue comes back, we're bringing that stuff on, but we had to be very quick and very meaningful on a lot of the cost containment measures we did, because the name of the game for us was just preserving cash and pushing out the burn.
Okay.
Yeah, a lot of the same measures from a corporate standpoint that Kevin talks about. I think that's been a common theme, unfortunately, across the entire hotel industry, whether it's layoffs, cuts, bonuses, reductions, you name it. Of course, the brunt of that has fallen at the property level, which has been really unfortunate, just because those are frankly the most vulnerable. But you know, in terms of how the capital partners are responding, Paul, probably two sides of that. On the bank side, most of what we've done about 4 or 5 years ago, we really made an intentional effort to shift from the larger banks, the Wells Fargo's, Bank of America's, U.S. banks of the world, into more regional lenders, largely because we just felt like the relationships there would serve us well in the downturn, and that has proven to be incredibly beneficial for us, because when it comes to negotiating forbearance, be it on interest or funding FF&E reserve or being able to use swept cash, those types of things, having that conversation with a Wells or US Bank generally means, hey, borrower, you need to fund a lot of equity. We'll let you do those things, but you're going to have to fund equity in order to do that. And that, frankly, is just not a realistic scenario right now for most hoteliers. So we've been able to negotiate a lot of concessions from our lending partners, but that's not also to say we're not making a ton of concessions as well to try and prop up the asset, which means coming out of cash flow that we have, reserves we have, or whatnot, to be able to help shore up those assets. On the equity side, we've been really intentional to try and not have a capital call in 2020. We've been able to do that. And that's largely because you're running a skeleton crew at many of the assets, and because we had reserves built up to be able to kind of sustain us. So that's been a critical element, and I think it's over communicating with those investors as much as we possibly can. I mean, it's monthly calls, which is unusual for passive investors, but it is really communicating the state of the industry, the state of the assets, kind of what our game plan is. And what we've seen is that investors have been really, frankly, really understanding in this environment to be able to say, look, obviously you didn't cause it, but you're handling it the right way and you're communicating with us and and you've got a plan. And so those are some of the lessons that we've learned. And I think, to be honest, it's probably built and strengthened those relationships for those folks to be able to say, look, that's why we have Woodbine as a partner. And hopefully that means that when we see a lot of the distress in the coming months, those guys are going to double down and say, okay, let's go on offense, which is generally where our focus is going to be.
For us, we only have debt on about 20% of our hotels. So, and we have no corporate debt. So we have mortgages with primarily life cos at about 20% of the hotels. And so we've worked with them to get forbearance for at least the first 6 months of this. And we've it's only a couple of different groups that we're working with, and we've got great relationships with both, and they've been amenable. We had one sizable package, actually our largest debt package, that was coming due this year, which we've negotiated to push out for 48 more months. So anyway, that side has been, only because of the lack of leverage we have, it hasn't been a huge issue. As far as partners on the hotel side, we own most of ours 100%, but we have a couple of 50-50 partners that it still makes the conversation pretty easy because we're pretty much 100% aligned. Sure, we manage the hotel for them, but it's hard times for sure, and deciding whether to open or close a hotel is a big decision, and whether we can actually lose less by opening the hotel, because they were pretty much all closed at one point. So those conversations we're having with our partners, but there's very good alignment there. So they haven't been too troublesome. Obviously, all the decisions are hard, and we made the same type corporate and field level decisions that Kevin and Dupree did. And we were about 22,000 employees on March 1st, and we probably got down to 1,000 at one point. We're probably up to 8,500 or 9,000 right now. And until we've got big group boxes, and until you're filling up ballrooms and using your banquet and catering staff, you're just not going to bring back your masses of people.
Actually leads into one of the questions from the participants. My son has been building his career in the hotel business for the past 8 years. He's a front office director, got hired back by Star Property after 7 months, then laid off. What do you have to say to people who love the operational side of the business, but obviously need to be employed? So anyone want to take that?
Paul, this may be IT issue on my end, but Paul, if you don't mind, speak up a little bit. I can hear all the other guys pretty well, but I have a hard time hearing you.
Okay, sure. No, a question from someone whose son has been working in the business, got laid off, and got picked up by another large hotel chain. What would you say to him? He would like to stay in the business, but he's uncertain about what his next step should be.
I can take that, and it's a little bit of a recruiting pitch, but I would say come to Aimbridge, because while we pulled down our revolver and we've got a really well-heeled owner, we were battling is the wrong word, but we were pushing our board to not cut as deep, whether it was corporately or at the properties, because we felt like we were being good stewards for the owners. And so even though we did make some cuts, right, we were probably on the lean side relative to, even what you saw the brands doing out there, because we didn't want to rip out and impair the company beyond that to something that was salvage value. So we still, again, we believe in the business model. We believe in the industry. So I would say, come give Aimbridge a call.
Good. Okay. So, anyone else?
I was just going to say, I mean, this is an unprecedented time. The industry's been around a long time, and it's been made for great careers for a whole lot of people. And, knock on wood, this doesn't happen again in anybody's career.
Yeah, it has been devastating. A lot of other asset classes too, right? I mean, we could go on, potentially other, office, retail, so on. But So now then, brings us to the part to talk about transactions and buy, sell opportunities and what's going on in the market. Are we starting to, is everyone just hunkered down right now, or are people trying to trade assets? And what are you guys seeing out there in terms of market activity? And how are some of those deals transpiring?
Sure, I'll jump in on that. So for Woodbine, there's kind of two different platforms that we're focused on. The first is a debt platform. So that's with a large institutional capital partner. And then we've got a GP fund that we're actually actively raising right now. And the purpose of that is to obviously you've heard from the three of us, which is a decent cross section of the industry. So 99% of folks in this industry are going to need runway capital for the next 2 to 3 years. And I think we're in a unique position as a operator, as a sponsor, to come in a way that most financial partners can't, to be able to support these hoteliers in figuring out how to get from A to B. And so generally we're going to be making preferred equity or mezz loans that are in that call it $10 to $30 million range. And we've got about $300 million to be able to put to work. So it's, I think from that standpoint, we feel a little bit better about a debt position right now than we do on the equity side. We like a debt position with equity returns. Naturally, everybody would, but I don't think we can really quantify the risk yet on the acquisition front. So we've been a little bit reluctant and haven't seen as much discounting as I think we had hoped to see at this point. Most likely what happens, I think that's going to be that's going to be fairly muted, to be honest with you. I don't think we're going to see hundreds of assets coming into foreclosure, because a lot of these lenders they're going to be forced to hold, and they're not going to be in a position where they even want to have the asset. So it will be interesting to see how that transpires. On the opposite side of that, you also have a ton of capital being raised in the space right now. So it wouldn't be a surprise to me if we see a smaller window of acquisition opportunities, and then pricing doesn't get bid up to a fair market value, but I think it's bid up to a lesser discount than you might be able to otherwise expect, because those cheaper cost of capital groups are going to be flooding the market. So just my own forecast, but I think the window's probably going to be in the next 12 months for at least Woodbine to be able to deploy that kind of debt platform.
Good.
Yeah, I'd echo some of those thoughts. I mean, we're actively looking, but not actually doing anything yet on the buy side, and we're talking to a lot of very large potential capital partners if something really big comes down the pike. I mean, the big question is how all the lending institutions handle these loans that are, they're going to have a hard time servicing their loans. Every big hotelier that has, unless maybe it's a resort that's performing well. And so if they react like they did in 2009, there's not going to be a whole lot of opportunity if they just work with them and kick the can down the road. But it's a lot worse this time. So, we'll see. And then on the disposition side, you referenced Paul yesterday when we were emailing that we've got 5 assets that are they're not core to Omni, that we've owned them since probably the early 90s. And as we've built Omni up and built a lot of hotels and added a lot of resorts, they don't fit the Omni brand anymore. So we're out to market with those right now. And we've got first round offers in, and that they're clearly below what we would have sold these assets for. And we actually had these ready to market in March, and we're going to market about March 20th. And for obvious reasons, decided not to sell them at that time, but then just decided to go ahead and test the market. And there was a ton of interest, a lot of people just kicking the tires, I'm sure. But then we actually got from qualified buyers a handful of individual asset bids and a handful of portfolio bids that we're taking best and finals next week, and we're optimistic that we'll get to a place where we're willing to transact. And so anyway, maybe more tire kickers than anything, but we've got a couple groups in there that are more than qualified to take down the whole portfolio. So we'll see where it goes, but it's still kind of mid-process.
And agree with both Blake and Dupree. Even though Aimbridge is not on the the real estate side, we're we do have a business development function that basically pairs up capital with opportunities. And so where we're seeing that is on the CMBS side. So 75% of the CMBS is either in special servicing or on some sort of advanced watch list. And so I think those are where the opportunities are going to be. I think Dupree mentioned it, but the banks aren't, keen to hold these things. They're not operators. And so I think that's where all the deals are going to be had. And so thinking about kind of the beginning of March through July, I think people were assessing their situations and the environment with their lenders, with the franchisors. I think the PPP kind of delayed any real transaction activity, and so now that's starting to dissipate. So I really agree that like the next 12 months is going to be critical to assets moving.
Good. Okay, well, maybe we'll shift gears a little bit. Dupree kind of touched on it earlier. It's sort of the innovation and the user experience. I don't know if there's anything more to talk about there, but I also wanted to talk about, something you mentioned actually, Kevin, the cleanliness, the new CDC rules. How is all that coming together for you guys? You mentioned the cleaning regimen was different. But is there anything more to share on cleanliness and the new CDC rules?
And I think everybody ended up at the same place, right? There was a lot of plagiarism going on, and that's common in the industry. But from a speed to market perspective, we felt like we were out in front of that, working with the brands, and all of the protocols we have are rooted in CDC, and we came out real fast on that. And so I think that helped us and helped others like us gain some market share, because it was consumer confidence, right? For the people that did want to take trips, that they were confident that they were going to go to a place that was thoughtful about their protocols. They had a training regimen. It was, contactless. And so I think that most of the industry is there now, right? But it's all about instilling a sense of confidence and security in your guest. And so, most of the restaurants and hotel companies, their guidance looks the same relative to their protocols there, but and the brand as well. But it's important that we take that very serious as an industry, because absent that, right, you just need a little bit of bad press. And I know the USA Today's done a piece. There's been some lashback there, but you just need a little bit to go wrong as somebody that's not compliant with the new norm in terms of cleanliness, and that'd be devastating.
Mm-hmm. So a little bit more on the innovation. Actually, I wanted to turn to the whole Airbnb concept as an innovative concept, and how that's impacted the industry. What kind of market share is Airbnb getting, and how's that affecting a larger hospitality industry? You guys have been here.
Yeah, I can jump in on that. I mean, Airbnb is currently taking a greater share of U.S. travel demand than this year in COVID than they were. And I think that's probably more a function of who's traveling. But I think at the end of the day, when you're talking about business travelers, it wouldn't surprise me if there is a higher expectation of cleanliness standards, which you can't necessarily guarantee. Now, they'll figure out a way to attempt to solve that, because they're going to innovate as well. But I think there's just Kevin, you mentioned this, a consumer confidence of traveling in the post-COVID world, at least for the first 12, 24 months. I mean, a Clorox partnership with Hilton ends up meaning a lot to a traveler. And so I think those types of things that you can't guarantee when you're staying in someone else's house or spare bedroom, I think really ends up affecting it. Now, again, what we've seen is this meteoric growth of Airbnb over the course of the last several years. I mean, literally the market cap and room size of Marriott in a matter of 5 years. And that is shadow demand that we didn't necessarily knew existed in our business. So, and we haven't seen that in a down market. So the real question is, how do they begin to compete over the course of the next several years? Does that growth start to stagnate? Do we see business travelers who are willing to shift now come back? I think that remains to be seen. I don't think Airbnb goes away. In fact, I think when you're talking about vacationing and things like that, you can make the argument on the other side where a family says, look, I don't want to be in a hotel with 100 other people or a resort with 500 other people. I'd much rather be in a house all to myself on my own with my family. So I think there's going to be segments that begin to shift to Airbnb, and other segments that they really needed to win big, which is business, probably go back to hotel. So I don't think it's a net gain, to be honest. I think it's probably a net loss at the end of the day, but I think they're still a tech company, and their multiple will reflect that.
What kind of conversations are you guys hearing from corporate, from companies? You mentioned earlier, Dupree, how you're trying to diversify revenue, extended stay, office space, F&B credits and different things. You know, I mean, are there serious conversations going on about temporary office space?
Yeah, absolutely. Absolutely. I mean, it wouldn't surprise me if, I mean, Kevin, you probably have somebody in the portfolio who's doing this. I mean, we're saying, hey, stay here, $80 a day for office, and you get lunch. You know, there's things like that we're seeing all over the country. And we're actively looking at assets that we have in our portfolio that are older extended stay properties that we're going to convert to multifamily. So there's no doubt it's happening. I mean, it isn't like, you know, kind of a dream. It's saying we have to pivot now if we're going to survive. And that's kind of what the industry's doing. There's, you know, Kevin or Blake, you guys may have other examples of things you're seeing, but that's kind of what we're doing.
We've had a number of conversations with various colleges that want to use the hotels for dorms, taking 200 to 300 rooms, which seems a little dicey to me, depending on how big their security deposit is. But and then on New York, not to talk about New York too much, but since we've closed, we've had no less than 100 inbound calls from some reputable people, some just brokers kicking the tires, but primarily to turn it into office. And some would be, I think most would probably be tearing it down and turning it into office. But like I said earlier, I think New York in particular, and maybe some other Northeast markets, I think there's been a lot of rooms that come out of the market and are repurposed, whether building torn down or repurposed the current that's there probably into condos if they repurposed a current hotel.
Right. Yeah, I mean, you would have to think that you guys can maximize the whole cleanliness standard and sort of that approach to it. And I think that would be a big selling aspect of people wanting to come back and find ways to use the hotels, but at the end of the day, maybe some repurposing of those assets. But I would think, since y'all had to jump on it pretty early in the process, that you've got a good chance to capturing some of that market. And as it fractionalizes in things like office, you know, Baker Tilly's been very conservative. We haven't been back to the office since mid-March. And you know, so everyone's taking a little bit different stand on that, but I'm sure it's going to impact a lot of different segments. So who knows what the future holds? That's for sure. It's evolving. It's very fluid, and so be open to take questions from the group. I don't know if anyone wants to raise their hand and ask questions individually. Haven't had too many come across the wire from me, but we definitely.
One thing while you're waiting on that, Paul, I think if you think about when your competitors start traveling, I think that's a big part of this. I mean, what I admired about what Omni did is Omni said, look, if we're asking our hotel employees to be at the front desk every day and greeting guests, then we need to be in the office too. And we've kind of followed their lead on that. And I think we're also saying that when we're meeting with the Marriotts or Hiltons of the world on owner advisory committees that we're on, we're meeting on Zoom, and I'm kind of raising my hand going, now hold on, like if we aren't willing to travel, then who's going to? And so I don't know. I did hear KPMG and a bunch of other big accounting firms are traveling, so we might have to get Baker Tilly on the road again.
Yeah, that would be fantastic. Believe me, it doesn't help our business at all to not be able to get out and talk to people and
Yeah.
build relationships. So, we can still go out and locally primarily,
Yeah.
but traveling is something that is still an important component. And hopefully, we're going to get back to that. We're just sort of, that's the current state. We're pretty optimistic for the first quarter, but we'll just see how it rolls. Yeah. Okay. Anyone raise their hand, Eric? Anyone else? Anything to ask or share?
I have not seen anyone do so yet.
Okay. Any of the panel members have questions for the other panel members?
Yeah, sure. Kevin, what do you think, man? I mean, the path to public does this completely derail that? Does it slow it down, or does it speed it up?
So I think it does two things. So I think it certainly slows it down, right? Because there's a period of time where, the story is just not there from a top line perspective. But again, we and our PE sponsor were kind of betting that there would be a down cycle, right? Nobody was predicting this, but we feel like if you can win on scale and quality and talent, right? I mean, I think that's a story worth investing in. And obviously, the debt markets believe in it to a certain extent, because we just closed on $200 million of debt, even though our publicly rated debt got downgraded in March at the outset of this. There are folks that believe in the industry, they believe in the recovery. And so there are deals to be had on the equity side, but there are also deals to be had on our side. And so we're going to be very active in that space. So not necessarily real estate, but we're going to look to buy out some of our competitors and shrink the market a little bit. And so we don't necessarily have to avail ourselves to our balance sheet to do that. We're getting creative and doing stock for stock deals. And so feel like now is the time to make hay and position ourselves for what we think is going to be a 2 to 3 year recovery.
Okay, we've got a couple of hands raised, so I'm gonna let Larry unmute here and ask his question.
Hi.
Larry, you should be able
I think I'm unmuted now. Can you hear me?
You are. Yes.
As you guys are modeling the recovery, are you seeing, is everything driven by kind of the U.S. Travel, or are you looking at international and certain countries being ahead of the U.S. as far as capacity in your hotels?
So we've got maybe 100 hotels in Europe. So all the way from England to Russia and a lot of countries, Central Europe in between the CIS. And so those are significantly down. So the restrictions there, but for a few countries where they have adopted the herd mentality is just a lot more prohibitive. And so they're I think further into a double dip, if you call it that. And so they're significantly worse from an occupancy, RevPAR, and an outlook on a recovery timeline than we are in the United States.
Okay, we've got one more question. I'm asking to unmute. Go ahead. We should be able to hear you now. Ushanda?
Yes, hi. Sorry, guys, I joined the call a little bit late, so sorry I missed the initial part of the call. But I wanted to know from the panelists 2 questions. First, as a hotel owner, what are 2 things that you advise a hotel owner do within the next 30 days to preserve the value of their assets? That's the first question. And the second question is, as it relates to the recovery, what is one thing that is keeping each of you up at night? Thank you.
I can answer the second question. The election is what keeps me up at night. And I think I'm confident in that we're not in control, and neither is whoever is in power at the end of the day, although we fooled ourselves into thinking that. But that could have a dramatic impact on the hotel business. That could have a dramatic impact on hotel owners, on real estate owners, from the tax code on down. That could really stop whatever recovery we're seeing. So that's my stab at the second one. I'll let Kevin or others take the first one.
Yeah,
I would say on the first one. Sorry, Kevin, go ahead.
no, you go ahead, Blake.
I would say on the first one, if you're trying to make decisions to save your business in the next 30 days, you're 7 months, 8 months behind.
Yeah.
So, well, we're hoping there's a recovery here, but we've positioned the business as best we can to weather this storm as long as it lasts. And we're looking at metrics and daily labor metrics that we probably should have looked at all along, and we'll be a far more efficiently run business coming out of this because of the things we're looking at every day at every single hotel, namely on the employment side and just the number of people and number of bodies we have in the hotel on a day-to-day basis. So, we implemented a lot of that stuff 7 months ago.
And I agree with that, and I would say that the probably the number one asset you have from a human capital perspective at the hotel is a general manager. So if you have a good general manager, make sure he or she is happy and incentivized and know that you're going to be there sticking with them. Make sure that they're sales minded, because there are some opportunities out there, right, with the recovery to get ahead of that on the sales and marketing side. So somebody that is thinking that way is going to help penetrate and just be that far ahead of the recovery. So those are my answers to number one, and then I agree with Dupree on number two.
Great. Anyone else would like to ask a question? Please raise your hand, or we're going to the panelists and Paul for his great moderation and the great comments from the panelists. Anybody else? Paul, any closing statements? We are going to try to do some networking at the end of this, so hang on once Paul is done, and we'll see if we can get that kicked off.
I just want to thank the panelists, Bree, Blake, and Kevin. I know it's a hard topic, and you're sort of having to share some of the inside pain a little bit there, but it's a huge industry in the U.S. and it's being probably one of the highest impacted industries, and maybe even long term, like you say. But I'm glad to hear there's options in terms of diversifying revenue streams, and as free market economies take hold here, there'll be innovations, repurposing of assets, and restructuring these deals. I really appreciate you coming on, giving your perspectives. They were very insightful and detailed and personal. I really appreciate it. Thanks again. Hope to have you back.
Absolutely.
Thanks, Paul.
Thank you.
Thank you, Paul.
Okay, all the other people on the call, if you'd like to hang out and just get in a room with some folks and talk, we're going to break it up into groups of about 6 people and we're going to do introductions of our background and something interesting, and then just sort of chitty chat, if you will. So usually we do this at the front. We'll see how many participants we have at the end today. So just hang on and we will break you into groups. Thank you. We're falling off quickly. Okay. We will try to do it at the beginning next time. That seems to work better. Looks like we're down to 15 people, so we'll go ahead and do that next time at the beginning. And thank you everyone for participating.
Thanks, Eric.
That's our program.
All right.
Take care.
Bye-bye now.
Thank you, guys.
Thanks, guys. Hi, Ron.
You don't want to stick around and talk to me, Eric?
Oh, I can hang out. We got 13 people. We can unmute everybody, and anyone that wants to chit chat
There you
can.
go. Let's do it.
So why don't we? Everyone should be able to unmute at this time. Is that correct? Kathy? If everyone could try to, yeah, so everyone can unmute and sort of say hi. I'm going to see if I can't get a broader screen of who we have on. Is Ron Rushing? You're still there, Ron? Why don't you say hi, introduce yourself, and we'll go from there.
Hello, everybody. Ron Rushing. I wanted to say it was a great program. I really thought that was one of the better SIG group presentations I've seen. Thanks for putting on such a good program. Great speakers. Good job, Kevin.
Thank you, Ron. Appreciate you. Nice to meet you.
Ron is the current FEI Dallas president. Warren, why don't you say hi and introduce yourself?
He's muted.
Warren, unmute yourself. Can you not unmute yourself? Somebody unmute Warren.
Okay.
There you go.
Got it unmuted. Yeah, no, that's fine. Thanks. And yeah, I did appreciate the program. Yeah, I just got out of a company that did primarily restaurant, retail, and hospitality. So got hit on all three of those. So no longer there, needless to say. I actually had a question for some of the panelists that probably invest not only in just commercial, but also in residential real estate. I'm kind of a small residential real estate investor myself. I don't know if any of the panelists have any comments on that, because what I've seen, I guess, is some housing prices drop, which is no surprise. People can't afford to rent and or mortgages. So I guess, what do you see for the near term and long term for that?
Well, unfortunately, I think the other panelists that could answer this question better than I can left. But my very ignorant observations is just like hotels. I think there's a flight from urban to suburban, and so I think, you know, getting ahead of that would be a good idea. And of course, with the interest rates where they are, you know, looking at refinancing is always a good play. But I'm a hospitality guy, so that take it with a grain of salt.
Got it.
Yeah.
Okay.
I've got some home builders and, you know, portfolio companies holding in single family homes. On the lower end of the spectrum, they are selling and selling fast, and in suburban areas. A couple of them have, a couple of the larger home builders are creating portfolios. They're building the homes, they're holding them in a portfolio, and then they're just renting them out. And these aren't cheap houses. These are, I mean, they're not terribly expensive, but rents in excess of $2,000 a month, say. On the lower end side, you know, there's a good market for those homes in the 100 to 150,000 mark. I don't think you're seeing suppression in real estate prices there. And one of them that holds a lot of mortgages, they've refinanced a couple of them and put them on payment plans, and they're back and paying their payments as of currently. So I think, you know, on the higher end, and the one that's renting them is sort of on the higher end. These are $250,000 to $500,000 homes that are being rented. So they're having good success doing that. And so I think that's where the cut mark is a little bit off. That helps, Warren. But I think when the prices go up a lot more than that, I think we probably are seeing some compression. So.
Okay. No.
John Richard, would you like to pop on? John? Or maybe Susan Chang?
No, I'm good. Thank you.
Okay. Fantastic. Anyone else want to have any comments or anything?
So I guess one question to Paul, kind of as a follow-up there, what's driving, do you think, that demand in the real estate?
Single family home perspective?
Yes.
Well, I think it's mentioned earlier, the suburban flight to suburban. You know, we've been going urban for many years now and wanting these master plan communities full of hotels and apartments and restaurants and entertainment. And now it's sort of, at least temporarily, kind of pushing back the other way. And this concept of holding single family portfolio homes and renting them out, whether they be, I don't think the trend is necessarily Airbnb, but longer term type of rentals is catching on because people don't want to, they sort of like the idea of being in a home and having more space, but these are millennials, for God's sakes. They don't want to have to mow the grass. I mean, come on. And so, home ownership and everything involved in it is not exactly what they're signed up for, but to be able to rent and be able to get in and get out without having a big capital outlay, I think is attractive.
Anybody else want to pop on? Go ahead. Okay.
Yeah, obviously, if things continue to compress and the markets don't recover anytime soon, you're going to see a lot of things happen. But I mean, the demographics of who's been highly impacted are, a lot of blue collar workers when you look at it. I mean, the accountants, we're able to work from our home, and in some scenarios that's possible, in others it's not. But the retail worker, the restaurant worker, food service, of course, hospitality, you got tons and tons of jobs out there in a retail environment of some kind. Those are definitely impacted, but there's a ton of other industries that just march on and are doing fine. And so I think it's, the recovery is going to be, kind of at a micro asset level and looking at it geographically, and where people are more highly regulated, states that are more highly regulated. Texas being a pretty open market, and most of my clients here are faring fairly well in that regard. So maybe just a shift, but hopefully not too long a one here, and a quicker recovery than some. And so that's where I think you're going to see some of these states that are putting down a lot of regulations. And the one in California just came out today. I haven't read it, but there's brand new regulations for theme parks, and everyone seems to be hollering that it's going to literally just crack, California's economy if this all continues to go through and they just shut all these parks down and regulate them so highly that they can't bring in revenue. So it's a big deal.
This new thing is a permanent regulation, or just?
I didn't read into it too much. I'll read a little bit more tonight, but no, I mean, I doubt that it's permanent. Let's hope.
Okay. Well, thank you to everyone. I think we're going to wrap now. I think it was a great event. Thanks, Paul, all the panelists.
All right.
Kevin's still here.
Thanks,
and you all take care, and we'll do it again soon. Thank you so much.
Thanks, Ron. Appreciate it. Thanks, everyone.
Thanks.
Bye.
Okay.